Over the last couple of weeks, in early June 2023, the crypto world has been struck by a tsunami that threatens the very existence of the biggest entities and cryptocurrencies themselves. The Securities and Exchange Commission, SEC for short, has unleashed a wave of lawsuits against the two biggest exchanges, Binance and Coinbase, as well as classified a whole chunk of the world's most popular cryptocurrencies as securities. These lawsuits might have the potential to drive the final nail in the crypto coffin, and the whole crypto space is going crazy. Time for a sanity check. Join me. To get the whole picture, we need to travel back in time a bit first. Does everyone still remember the Bernie Madoff of crypto? The effective altruist Sam Bankman-Fried, who has left FTX clients destitute to the amount of over $8 billion? We could argue that the whole FTX debacle kick-started off as somewhat of a beef between Sam and the CEO of Binance, Changpeng Zhao, or CZ for short, on Twitter. It resulted in sparking the bank run on FTX that sealed its fate, with Sam seen here in a completely tone-deaf response, congratulating CZ that he won, and this response sums it up most perfectly. This isn't about winning or losing, everyone lost. The fact that you still view things in this paradigm is very alarming. Fast forward to today, and it seems the losing isn't done yet. Some may say that CZ and Binance have been riding somewhat of a high horse since, and that their hubris might eventually come back to bite them right in the behind. The whole crypto industry has sort of acted like that with FTX gone, there's nothing but milk and honey left for the taking. The so-called bad actors have finally been wiped away, as Sam was just the final boss of the series of crypto disasters that year, following the collapses of Three Arrows Capital, Celsius, Voyager, BlockFi, and many other smaller ones. Those that consider themselves playing safe enough fought to feel free raking in real money in exchange for the various crypto tokens minted out of thin air. However, they have all forgotten about what that jolly old chap Sun Tzu wrote in the ancient art of war millennia ago. All warfare is based on deception. Hence, when able to attack, we must seem unable, pretend to be weak, that they may grow arrogant, attack where they are unprepared, appear where you are not expected. If there's anything to be said about this, is that the SEC did conceal their power after the FTX collapsed quite well, and allowed the crypto industry to continue on with impunity for months, making everyone believe there's absolutely nothing to worry about. Now, there's one more quote from the Art of War that perfectly describes what has happened in the last few days. Move swift as the wind, and closely formed as the wood. Attack like the fire, and be still as the mountain. And moved swiftly, and attack like fire. The SEC sure did. In a span of one day, it sued both Binance and Coinbase for sale of unregistered securities, and tore Binance a new one with even more severe charges that make it appear that Binance wasn't all that different from FTX and its Alameda research. Here, we can see that Binance has operated alongside three other entities, effectively owned and directed by CZ and Binance. BAM Trading at the top, with two others, Sigma Chain and Merit Peak, that were the market makers behind the scenes. The allegations are serious and appear pretty similar to what FTX has done. Commingled customer money without a care or supervision, which is a big no-no. At least this time around, the Binance insider whistleblowers have gotten to the authorities before everything blows up and millions of people lose everything again. Now, there's another area of Binance's operation that the SEC has a tremendous gripe with: the bypassing of limitations set in place for US customers to use the international version of Binance. See, Binance, as well as most other crypto brokers for that matter, has to follow a vastly different set of operating rules in the US compared to the rest of the world. And as such, It has a US and an international version of the website. The downside to the US website for the aspiring, eager to be financially free off of dog money American is that the selection of the next future of finance tokens is severely limited, namely just over 50, while the international users can enjoy hundreds of different kinds of must-haves in anyone's investment portfolio, such as Hook, Woo, Jasmy, Joe, and Dodo. Now, I don't know about you, but if you ask me, these certainly seem like names to throw one's life savings behind, right? Now it's time for a few thoughts we can kind of call hot takes. Some have no kind of factual proof behind them. They're purely conceptual and just a product of my observation in this crazy crypto market over the years, but others are clear as day. The reason we need this amalgamation of ideas, concepts, and what evidence there exists is to try and better understand the inner workings of how the money is slushing around in the crypto ecosystem and how it all connects back to the lifeblood of the exchanges, stablecoins, and ultimately the cryptos on offer themselves, to finally Gary Gensler's crusade and the SEC. And hey, if you enjoy my content, they say a like and a sub to the channel makes you a legend around these parts. So, to me at least, it seems that the biggest players that control the fiat money to stablecoin gateways on one side, namely Tether, and the market makers and exchanges/brokers on the other, are in well-coordinated cahoots with each other, driving the engines of the crypto market, whose main purpose is to extract as much legal tender money from disillusioned clients, with big personalities and celebrities selling the dream of freedom and prosperity to the public. The only clear link that's in the open is between the stablecoin issuer Tether and the exchange Bitfinex, which are both owned by the same parent company iFinex. Now, in the true spirit of crypto delights, the CFTC, or the Commodity Futures Trading Commission, has already fined the company for $41 million back in February of 2021 for misleading information on how its stablecoin is backed. After which, Tether kept promising a full audit instead of completely arbitrary so-called proof of reserves, which exists purely on trust me bro authority. Now it appears that Tether is undergoing regular accounting assurance reports. That's not a fully legitimate audit, more of an opinion. Outside of the British Virgin Islands, where the company is registered, themselves probably not being a promised land, free from all kinds of corruption and questionable regulatory scrutiny themselves, are these reports to be trusted at all? When we look a bit deeper and analyze the players involved in the reporting, the results may not be so clear-cut as they seem to be. The accounting firm used for the Hong Kong-based Tether was the Italian arm of a company called BDO. If the fact that an Italian firm was contracted to fine-comb another in the basically financial center of Asia, Hong Kong, yet registered in the British Virgin Islands doesn't raise any eyebrows, the fact that BDO has, let's just say, less than stellar performance when it comes to its track record and has resulted in multi-million-dollar fines all over the place, well, it surely does raise mine. Performance such as deemed to be of unacceptable quality in their audits by the UK accounting regulator, with the worst industry scores 2 years running, with only 58% of audits passing inspection. Investigation over auditing of a construction company gone under. BDO auditor fired over altering files marked for inspection. BDO's Spanish arm sued for helping conceal over $3 billion in debt. Gross incompetence resulting in a pension scandal in Zimbabwe. I'm not making this up. And last but not least, Ontario Securities Commission fining BDO in sum of $4 million over investigation of audits of 2 different funds. That exposed their general mode of operation, consisting of failures to resolve inconsistencies, deficient reporting procedures, failures to confirm appropriateness and reliability, not following their own stated methodology, and failing to obtain evidence needed for verifications. The following remark of Ontario Securities Commission Director, in my opinion, sums the whole reality of this company auditing Tether and its validity perfectly. Quote, "Investors rely on auditors to carry out their work with professional skepticism and proper oversight. When they fall short, investors lose confidence in the integrity of financial reporting, a cornerstone of capital markets." This is the kind of company whose opinion is enough for the whole crypto world to trust Tether with over $83 billion. The kind of company that can produce $1 billion of new Tether dollars willy-nilly with only a pretty convoluted salad explanation to go alongside it. And its connection to the exchanges, oh nothing, just tens of billions of daily trading volume. Outside of that, in general, that's a conspiracy I have no more evidence for, as the Flat Earth Society does. But hey, things have happened not so long ago in this crypto space that were supposed to be completely unheard of. Yet they still did. Now, the next thing to talk about are the actual cryptocurrencies that these exchanges offer for trading, and especially the ones mentioned in the SEC lawsuits as being securities on offer illegally due to not being registered as such to the SEC. So, what is a security? In investment terms, the most broad explanation is a form of ownership in an entity. However, that's vastly expanded in the official definition in the Securities Act, as you can see here, and it goes far beyond the scope of just stocks and bonds. Basically, any financial instrument is considered a security. And if there's any doubt about it, as you can surely have seen mentioned before, there's this so-called Howey test to determine whether something is a security or not. The name Howey test itself originates from an interesting Supreme Court case from the mid-1940s. A company called W.J. Howey was selling plots of land with citrus groves growing on them. The buyers then leased the plots back to the company that grew and sold the oranges and shared the profits back to the plot owners. The SEC then sued the company for not registering with them. The case got to the Supreme Court, which ruled in the SEC's favor, and that set in stone the 4 criteria to define a security, which are still used today. As a side note here, I do find it funny how most of the crypto bros will scream off the top of their lungs that crypto will never pass the Howey test, where it's clear the SEC did sue and win for clearly less severe and frankly slightly ridiculous incidents in the past. So, what's this Howey test then? It's actually pretty simple and can be boiled down into one sentence. A security is an investment of money in a common enterprise with profits to come solely from the efforts of others. And if that test be satisfied, it is immaterial whether the enterprise is speculative or non-speculative, or whether there is a sale of property with or without intrinsic value. What's interesting to me is that I've listened to countless explanations of the Howey test by various crypto diehard advocates, and none of them ever mentions the latter part of the definition. I've heard some say over the years that since we're dealing with a speculative asset with no intrinsic value, it doesn't really matter. But it seems to me that they haven't really taken a second look at what they were saying. Even a completely speculative asset with zero intrinsic value, which honestly 99% of all cryptocurrencies are, is a completely valid candidate for a security. And the way most of them are structured at their high end, with a centralized entity in the form of a so-called non-profit foundation and a parent company that does in effect control the issuance and distribution of tokens, and a founder figure in charge, that eerily mirrors a security issuance and a company structure. Let's take Solana, for example. On the surface, we have the non-profit Solana Foundation, which in the background is coupled with absolutely for-profit company Solana Labs, with CEO Anatoly Yakovenko at the helm. Solana Labs is privately held, venture capital backed, complete with an executive suite and a board of directors. Here's where the meat and potatoes of the lawsuits comes into play. The way the parent Solana company generates income is through the sales of Solana tokens, and the Solana Foundation does all the other grants and building incentives. And although as non-profit, one can't exist without the other, and as such, it's easy to see where the SEC is coming from. The success of Solana is inherently dependent on the success of Solana Labs, and there we have the pivotal setup where the profits from investing in the common enterprise come from the efforts of others. The Solana tokens that Solana Labs sells to whatever private investors are the exact same Solana tokens everyone, including you and me, can buy on a crypto exchange too. Not completely unlike how publicly traded companies deal with their shares. But it's not exactly the same either, so that's why it'll be to the courts to determine what's what from this point on. And the vast majority of cryptocurrencies follow the exact same playbook, which in turn gave the SEC just enough to strike at all of them at once. The major exception from all these lists is Ethereum and its native token ETH. The jury is out on this one. It could be either that the SEC is first gunning down everything but the biggest non-Bitcoin cryptocurrency, and coming for Ethereum down the road if they're successful with the rest. Or perhaps it really doesn't fall under the securities umbrella, but that remains to be seen. The biggest difference with Ethereum is that there's no direct for-profit company overseeing its foundation. That being said, considering how Ethereum's founder Vitalik Buterin and the foundation have been selling their ETH to raise funding, may be used to argue in court one day that all this resembles how publicly traded companies are issuing and selling shares to raise funds. But that's just my guess. I'm not a lawyer, and it'll be for the courts to decide. So, where does this all leave us? Well, with some immediate consequences and some philosophical questions. Two of the online brokers that also offer traditional securities in the US, Robinhood and eToro, have already announced that they will drop support for the cryptocurrencies on the SEC's list by the end of June of 2023. If we follow the example of XRP, which was the first major cryptocurrency that got sued by the SEC years ago, and whose case still isn't resolved, there's a good chance other exchanges will follow suit in delisting the same cryptos. Right now, the Binance case remains on a fast track, because the SEC seeks extraordinary relief, like an asset freeze and the repatriation of billions of dollars. The SEC believes that not only that the evidence of fraud is overwhelming, but also that investor funds are at risk. This would have huge implications and might shake the crypto foundations even harder than FTX did, for example. What does all this mean for the future then? Well, to be honest, I don't think anyone truly knows at this point. Such big moves that have happened recently are just unprecedented. If the crypto industry is forced out of the US like this, the consequences could be severe. Will this spell the eventual end of thousands of cryptocurrencies? We're about to find out. And do we even need them? How is cryptocurrency faring in its journey towards a decentralized future of finance for everyone? Or is it evolving into an efficient money-making machine for the pockets of the few? Hit that like and subscribe buttons, and join me next time for a sanity check on Bitcoin and where cryptocurrency fits in today's world in general. And I promise I won't talk about NFTs for more than a minute. For now, that's all from me. Peace.